Hi there. Let's take a look at one of the methods of pricing strategies. This one is competitor pricing. Well, what do we mean by competitor pricing? Well, you may have seen it in action. If you look around any of the major supermarkets, they often compare their prices and perhaps claim to at least match the price of perhaps a low-priced competitor. That's an example of competitor pricing in action. What we mean by this, it's pricing that is based on competitor prices rather than another factor, such as the costs of actually making or buying the products. Now, why base your price on competitors? Well, if your prices are higher than competitors, then in markets where consumers and customers face lots of choice, there is the risk that your prices are too high, that a consumer will decide that they would prefer to have perhaps the same product or same type of product for a lower price, and therefore you are uncompetitive. Similarly, if your prices are lower than competitors, it may well be that you're earning lower profit margins than you need to, and that you could still achieve the same demand if you raised your prices to reflect those charged by other businesses in the market. Don't forget, though, that competitor pricing isn't always about remaining the same as competitors. It could be setting your prices slightly higher or slightly lower than competitors. So it doesn't have to be the same. It can be slightly higher, slightly lower. Why would you do this? Well, clearly, having prices that are consistent with competitors means that you remove one of the potential advantages that competitors have, which is a lower price. That might not be the only advantage they have, but it's one which hopefully gets removed. And if you can do that, then you may end up creating in the mind of consumers and customers a consistent positioning about your pricing compared with the other competitors in the market. Competitor pricing often used as a defensive mechanism in order to try to sustain and protect market share and also to boost gross margins if your prices are too low. So that's why we see competitor pricing used so much in the supermarket industry, perhaps one of the most intensely competitive markets there is. And one of the reasons why they can do it is because competitor pricing these days is relatively straightforward in terms of accessing the information and in many cases automatically changing prices on the price display. So dynamic pricing enables competitor pricing to be done more easily. What are the downsides? Well, clearly, if a business has different costs compared with the competition, then it may well be that simply deciding to base your prices on competitors means that you're going to earn a much lower margin or gross profit margin than the competition. So if your competitors are more efficient, if they have economies of scale, a bigger business, then basing your prices on theirs means that they're going to earn a higher gross profit margin. And potentially that's costly not just for large businesses, but also in particular, I guess, for new and smaller businesses that need to earn the margin in order to reach the break-even level. And of course, the other question is, what happens if competitors have got their prices wrong? They're setting their prices at an unsustainable level, for example. You choose to follow their prices, you're simply replicating their mistake. So there we go. That's just a quick introduction to this concept called competitor pricing.